Today we're going to review the current tax situation for someone who is earning minimum wage in the UK and they're 21 years and over. So let's jump into this. To start with, the minimum wage for someone who is 21 years and older in the UK is currently, in 2024, £11.44 an hour, or £23,795.20 per year. This is due to change in 2025, but for now, let's just keep it where we're at. The tax that you're going to pay on minimum wage in the UK this year is going to be every day, that's going to equate to £8.27, and every year that's going to be £2,149 of tax that you're paying. Here's the breakdown, and this is for someone on a standard tax code of 1257L, which if you're earning this amount of money, that's likely the tax code that you're on. If this looks different in your payslip, maybe bring it up with your employer to see what's happening. As we can see, we're paying zero tax for our nil rate band of £0 to £12,570. This is the number reflected in the tax code. Then beyond this, we pay 20% tax on everything above that earnings limit. And as we're under the next tax bracket of £50,270, we're only paying 20%. This comes to, again, £2,150 per year. The next deduction we have, which is essentially tax on top of the tax, and it's a hidden income tax, is national insurance. This you're going to pay about £3.31 a day and about £1,000 for the year coming up to it. So between the tax and the national insurance, you're looking at deductions of £3,000 a year from your paycheck. What this looks like, again, national insurance has a nil rate band of £0 to £12,570, where you're going to be paying zero on that. However, again, as we step up into the next tax bracket, you're going to be paying 12% national insurance payments on everything you earn in the range shown. Again, this equates to £860. Moving on to the more positive side and what you actually are earning, every day you'll be adding £1.83 to your pension, assuming a 2% contribution rate, which is generally what auto-enrolment and employers will recommend that you join on to. This will save you a bit of tax in the year, as we'll look at in a second. So every year you'll be adding £475 to your pension pot. The thing to note about pension pots is this reduces your annual taxable amount. So effectively you're getting tax relief of 20% on that money that you're putting in. If you were to instead have taken this £475 of the year as pay and not enrolled into your pension scheme, you would instead pay 20% tax on that, which would leave you with £380. So it depends on whether that's more important for you to have now, or whether you're happy to put that aside and save it for later, and then you're starting with a stronger base. In terms of your net pay, so what you're taking home in your pocket, in your payslip, every day this equates to £78, and over the year this equates to just over £20,000 that you'll be taking home. This is after all of the deductions of tax and national insurance. It's worth noting that if you have a student loan, this annual salary does not exceed the repayment threshold, so even if you have a student loan, you will not be paying any of this back. Let me know what you think about this salary down in the comments below.